Jenny Werwa, the Director of Public Relations for the National Reverse Mortgage Lenders Association. Thank you so much for joining Nirmala and our distinguished speakers for this webinar, Silver Divorce, Home Equity Strategies for Separating Spouses. This webinar marks the sixth in a series that we've hosted this week for Reverse Mortgage Education Week. So thank you again for joining us. Among U.S. adults aged 50 and older, the divorce rate has roughly doubled since the 1990s. According to analysis from the Pew Research Center, while the rate of divorce is lower among adults ages 50 and older who have been in longer-term marriages, a significant share of gray divorces do occur among couples who have been married for 30 years or more. Pew researchers note that the growing trend called mature gray or silver divorce could be based on the desire by one or both spouses for new independence and opportunity. But they explain there are also downsides. Later in life divorcees tend to be less financially secure than married and widowed adults, particularly among women. And living alone at older ages can be detrimental to one's financial comfort and, for men, their satisfaction with their social lives. Today, certified divorce financial analyst Diane Pappas, retirement income planning expert Professor Jamie Hopkins, and certified reverse mortgage professional Dan Hultquist are going to talk about the financial challenges facing older divorcing couples and also discuss some of the solutions that can help to support both spouses. Before introducing each speaker, I want to encourage you all to post questions in the chat box on the GoToWebinar platform. We'll answer as many questions as possible after the presentation. I also want to let you know that this webinar is being recorded and will be posted to our website, nirmalaonline.org. You can find today's slides as a handout that you can download from the dashboard, along with 3 consumer guides to reverse mortgages. These can also be found on Nirmala's consumer education website, reversemortgage.org. I am pleased to be introducing Diane, Jamie, and Dan. Diane Pappas is the principal of Solutions for Divorce, LLC, an independent fee-only divorce financial planning firm and registered investment advisor serving the North Shore. She is an investment advisor representative, financial planner, a collaboratively trained financial neutral, and a trained mediator. She is currently serving her second term as co-president of the Divorce Center and was recently selected to serve a 3-year term on the board of advisors of the Institute of Divorce Financial Analysts. She is also part of the North Shore Community Mediation Center, providing her services as the resident CDFA. Jamie Hopkins is Associate Professor of Taxation at the American College and the Retirement Income Program and is co-director of the New York Life Center for Retirement Income. He also holds the Larry R. Pike Chair in Insurance and Investments at the college. Teaching courses in retirement, estate planning, and life insurance, he has educated thousands of financial services professionals and continues to move the needle for retirement income planning. Dan Hultquist is the Director of Learning and Development at ReverseVision, the leading technology provider for the reverse mortgage industry. He has spoken nationally on the topic of reverse mortgages, and his training sessions have exceeded 21,000 in attendance over the last 6 years. He is a certified reverse mortgage professional and co-chairs the Education Committee for the National Reverse Mortgage Lenders Association. He also teaches continuing education courses that serve as annual requirements for CRMPs. And with that, I'd like to hand the presentation over to Diane.
Thank you, Jenny. Hi, everyone. Jenny, thank you for giving me the opportunity today to be a part of your Education Week. I could talk for hours on this topic, but I only have 12 minutes, so I'm going to jump right into it. Let me just first apologize if I talk too fast, because I'm originally from New York and I can talk really fast if I have to. So I'm going to talk about the financial challenges of a silver divorce as seen through the eyes of a certified divorce financial analyst. What is a CDFA, or a certified divorce financial analyst? Typically, it is a certified individual with a financial planning background who specializes in the financial and tax issues surrounding a divorce. So as you can see on this slide, the CDFA incorporates the skills of a CFP, Certified Financial Planner, and a CPA, Certified Public Accountant, as they relate to divorce. A lot of times in divorce, the traditional financial planning concepts and rules of thumb are basically out the window in a divorce. So a paradigm shift occurs for CFPs and CPAs when working with couples going through a divorce, especially in a silver or gray divorce, as we call it in Massachusetts. There are a multitude of tax issues that are specific to divorce, like those surrounding the division of property, the sale of the marital home, retirement plans, alimony and child support, and there are specific tax codes that address them. So a CDFA is uniquely qualified to address the tax issues and also the financial issues that come up in certain cases in divorce. You don't have to be a CFP to be a CDFA, or you don't have to be a CPA. We just have that knowledge, a working knowledge of both of the different areas. There's a lot of tax codes like alimony recapture and reclassification that are so obscure that I have found that some CPAs are not even entirely familiar with them. So especially in a gray divorce, and I keep calling it a gray divorce, it's what we call it in Massachusetts. I don't know if I like silver better. It is essential that one really analyzes any possible current and future tax implications that might occur due to a proposed settlement. Mistakes typically cannot be fixed post-divorce without spending more money and maybe going back to court, which is really the last thing you want to do. So you really only get one shot at property division. So I understand we have a wide variety of professionals out there today, and if there is one takeaway that pertains to everyone, it's this. If you really care about your client and they tell you that they're contemplating divorce or going through a divorce, refer them to a CDFA who can really help your client through this overwhelming process. Not only will it help build trust with your client and solidify your relationship, but you'll be helping your client through one of the most traumatic and devastating times of their lives. So there are many benefits to working with a CDFA. And the first benefit that comes to my mind is that a CDFA can help your client choose the right legal process. What does that mean? Well, not every case has to litigate and go to court, which can be very expensive. And as you know, it can be really just downright ugly. So there are alternative dispute resolution models like mediation and collaborative law that may be better suited to your client's needs. But you won't know that unless you really understand what their needs and their goals are. I'm finding that a lot of my clients are coming to me first before going to an attorney because they realize that divorce is unfortunately all about the money, and they really want to understand what they're up against. So that once I understand what their issues are financially and emotionally, then I'm better able to refer the right attorney. So that is really important in choosing the right process. When a client comes to me first, or when they work with a CDFA, they typically have more control. And that's because a CDFA is empowering them with the right information and demystifying some of those complex issues. Very often, especially in a long-term marriage like we're talking about here, one person has more knowledge of the finances than the other. It's typically the wife who has stayed home to raise the children and take care of the home, and she may never have worked. She may not even know what they have in terms of retirement money or even how much her husband earns, and I run into this all the time. So a CDFA helps to level the playing field so that both parties have the same information. And when they do that, when they both have the same information, it allows the spouses to negotiate, hopefully with confidence, because they have the clarity of the issues, and now there is a greater focus on reaching an informed settlement. And finally, what we all like to hear is that when you work with a CDFA, you can minimize your legal fees, minimize the taxes, but maximize the marital assets. So what are the unique challenges for divorce over 50? Most of the challenges that you see on this screen right here are basically the same in all divorces. They all have these issues. But the difference in a silver divorce is the timeline. The fact that retirement is right around the corner makes it even harder to make those adjustments like you can when you're younger. So one of the statements you'll frequently hear people say is now there are two households that have to survive on the same income that once supported one household. This is nothing new, but now it becomes more of a challenge because it's occurring later in life. So there may be reduced employability or no employability at all, or health issues that prevent a spouse from adding to their income. most of the challenges that we see in a gray divorce surround the marital home and the retirement funds. So challenge number one, what do we do with the marital home? There's typically three options in a divorce, what to do with them. You sell it, you can own it jointly, or do a buyout. And a buyout is where one spouse buys out the equity of the other spouse. Owning jointly is typically not an option for older couples, as this really only works when there are children who are graduating from high school or college in a few years, and they can own it jointly and sell then. So we're left with to sell the home or a buyout. So what do we do? Can one spouse who is already in their 60s really afford to buy out the other spouse? Is it better to sell the house and rent or go into senior housing? I have a case right now where the husband is 63 years old and he really wants to stay in the house, but he just can't afford to. And then Jenny contacted me about the reverse mortgage, and she brought up a very interesting point of how you could use a reverse mortgage to help stay in the home and to affect a buyout. So I thought about it, but unfortunately the circumstances of this case do not lend itself to reverse mortgage. So unfortunately there's no choice. They have to sell the house, but the thought of going into senior housing is just very upsetting to him. So I can see where a reverse mortgage is a way to think outside the box and maybe provide some options for people that did not have options before. The other thing, avoid the knee-jerk reaction. A lot of times that is the wife or the one of the spouses saying, I want the house no matter what, and you keep the retirement. Well, that rarely works, and it's especially in a gray divorce, it's just not an optimal solution. So we want to try to think, what can we do to be creative? Everyone needs a place to live, and this issue should really be addressed up front so there's enough time to do creative financing, like the possibility of a reverse mortgage to assist in a buyout, or even to create just more income, or to help in the purchase of a home for the out spouse. The question that's really important here is, can the in-spouse really afford to stay in the home? So you have to really dig deep into a client's everyday living expenses and what it takes to actually run that household. Many people don't consider the future repairs and maintenance that they have in a house, and nor do they even average out their utilities over a 12-month period so they really get an accurate picture of what they are spending. Any of you people out there who are CFPs, I know you spend a lot of time working with people on their cash flow and their expenses, and this becomes really, really important in a gray divorce. So that's the challenge number two, is finding income. We know that post-divorce expenses play a major role in the analysis. What are the expenses going to be after the divorce, when now they're paying for the house on their own? Is there enough income to support that daily living? The other question becomes, will there be alimony or spousal support? And that really depends. It depends on your state's guidelines. In Massachusetts, alimony typically ends at the payor's full retirement age, which is for Social Security, but there are circumstances, if there are certain factors in a case, where alimony can go beyond the FRA. So Social Security plays a big role, and it has to be analyzed to see what the options are, and there's just too many guidelines to go into that now. Mind the gap. This is the time between alimony ending and the beginning of Social Security, or the beginning of taking your required minimum distributions. How can you, if there's a gap, how can you fill that gap? Maybe a reverse mortgage can do it, or maybe you can use a 72T2C. Try saying that 10 times fast. That is a one-time early distribution from a 401k per a divorce agreement through a quadro, which is a qualified domestic relations order. And what it allows someone to take a withdrawal from a 401k as the alternate payee if you're under 59.5, and you will not pay the 10% penalty. You still have to pay income tax, but you won't pay the 10% penalty. It has to occur when the split when the split of the account occurs for the alternate payee, and you also have to account for the 20% that's going to be withheld in taxes. but I can see where thinking outside the box, a reverse mortgage might be a really good idea, a good way to find some cash and some additional income to help someone through that difficult time. And then finally, the third challenge is there enough retirement? The first thing that you have to do is look to see what kind of retirement plans there are. IRAs, 401ks, 403bs, and pensions. Although you might say that pensions, private pensions really don't exist or aren't as popular anymore, in Massachusetts and all over, we have a lot of teachers who have pensions. We have a lot of state and city workers who are all on the Massachusetts retirement system. So a lot of my clients have pensions. And one of the misnomers about a pension is that they are sometimes undervalued, and people don't realize how much their pension is worth. So it's really important that when you have a pension, that you find someone who can value a pension for you, and a CDFA is able to do that as a starting point, and then for negotiations, and then you can always get a private party to do that, a valuation firm. So and qualified plans have different ways of dividing them. It's called a quadro, Qualified Domestic Relations Order, and a pension is typically divided through a domestic relation order, or a DRO. The other thing you need to consider is the parties' respective incomes and liquidity, so that optimal choices can be made when you're deciding what to divide. A lot of times in Massachusetts, things are divided 50-50, or at least that's a starting point. And maybe we need to do more. Maybe we need to do a 60-40 split. Maybe we need to find some other way to ensure that both parties will get through their retirement intact. But again, sometimes it's just not always possible. So how can we avoid financial disaster? And it really begins with choosing the right legal process, being financially empowered. Really help your clients to get through this, giving them the right information, providing them with the experts. And then, especially in a gray divorce, we really must consider the retirement assets and how to divide them the right way. Okay. That's it.
Thank you so much, Diane. I really appreciate your time today and your presentation. That was excellent information. I now would like to hand our presentation over to Jamie Hopkins, who is going to talk about strategies that include home equity. Thank you, Jamie.
Thank you, and hopefully my audio sounds good. If it doesn't, just let me know. So what we have here is kind of just my starting slide of a little bit about who I am and where I am and what I do. So some of you, if we have some CFPs and CHFCs out there, might already know me, or even had the misfortune, I guess, of having to sit through classes with me. Luckily here we won't be with me for as long, but I'm a professor at the American College of Financial Services, and I also am one of the two co-directors of the New York Life Center for Retirement Income. What I do is really very specifically looking at retirement income planning. Our goal here at the American College is to educate financial advisors and improve advice to consumers through, kind of improving financial advisors and their ability to communicate with clients on really difficult and growing topics. One of them being the topic that we have here today, home equity and reverse mortgages. So why is this such an important topic, especially in divorce situations and in financial planning? A lot of it comes down to this. This is a chart that I love using in presentations. It's from the last time we had the U.S. Census. We'll have another one in not too long. But what do you see when you look at the U.S. Census data? What you see is the average 65-year-old couple has about twice as much value in their home as they do in other non-equity assets. So you look at this and say, okay, where is America's wealth? Well, America's wealth is all over here in their home. So as we're splitting up assets in a divorce, as we're moving through retirement, anything that we're doing, we have to be aware of how important the home is here. Now, you could also add Social Security into this slide. I have another one where I then layer that in on the next one. I didn't do it here. But if you layer that in, you'll see that Social Security, if you valued it as a present value asset, would likely be one of the more kind of valuable ones. But so that's really kind of where Americans sit with home equity, with their non-equity assets, and Social Security. Now, a lot of people's clients, right, their assets probably don't look like this. They probably look a little bit higher in non-equity assets. They're probably not getting great financial advice, divorce advice, tax advice if this is their asset level. Well, this is the average American. We actually say average here. It actually is the median value. So it really is kind of a more pure average in the middle, what the average American looks like. If you kind of average with high, the Bill Gates, it's not, I don't believe he's 65, but the Warren Buffetts in the world, it tends to skew this over a little bit more. People look like they're a little bit more wealthy, but in reality, they're not. And so we have to look at home equity. It's just fundamentally, this is where value is in the United States. It dwarfs everything else, right? That is the most valuable thing we have here is land, and that's really been true throughout history, right? Land equaled power, and it still does. Land is value, and that's where the majority of Americans' assets sit. So when we're doing good planning, whether it's divorce or financial planning, one of the first things we should do is be identifying available sources of income and assets. And through a divorce, we're going to be kind of separating those out, as we just heard from Diane. But, as we're trying to tie that into financial planning, part of it's going to be the next one, and part of it is goal-based planning. And this is where, hopefully the client's not being overly emotional in certain areas, and hopefully we're guiding them kind of to a correct process by giving them the correct information, by empowering them with knowledge. But, a lot of our planning is goal-based planning. What is it that the client wants? And then what's the most effective way that we can do that for the client? And so that gets us to the last one, right? What is the most effective strategy? We know what the client's assets are, which hopefully isn't too terribly difficult to figure out, right? We're going to go through and look at their tax returns, and we'll look at their accounts, and we'll figure that out. Goal-based planning can be a little bit tougher, right, to figure out what is it that they actually want as opposed to what they tell us they want. And then how do we kind of get to that goal, right? How do we get there? And, the classic attorney answer to everything is it depends, right? It depends on the situation, depends on their asset level, it depends on their income sources, it depends on what state they're living in, it depends on what's happening with their spouse. Sometimes it depends on the age differences between their spouse. Do they have kids? And then some of those non-financial or verifiable things, what their legacy goals and needs are, what their health issues are. And so, can the reverse mortgage come into play there as part of that strategic part, as part of putting, taking the assets and the situation and putting it into a strategy that improves and kind of best meets the client's goals? Well, before we can even kind of get to that, I think it's important to understand the client, understand who we're going to be dealing with out there. And, I am, a believer in reverse mortgages in the sense of, I've seen the math, and in a lot of situations, right, the math just vets it out for me that it's the best thing to do in a lot of situations. The unfortunate thing is there's a huge negative perception out there towards reverse mortgages, both from the clients and from professionals. And so anytime that we're dealing with a strategy, a product that has a negative starting point, we have to own up to that. We have to realize it. And so when we look at clients, they're not always going to look at this as a favorable strategy. They're also probably going to need education. They're not going to understand reverse mortgages well. They're not going to understand strategic uses of them well. And most likely, if there's a team of people on the case, a reverse mortgage specialist is probably going to be needed because, to be honest, the financial planner, the CPA, and the divorce professional are, again, probably not going to fully understand reverse mortgages. it's unlikely you're going to run into somebody with all those skill sets. But are they out there? Of course, there's some, but it's not that likely that we're going to see that, especially somebody who understands kind of actually how to go through the process, the fees, the costs associated with it, the different distribution options. It's going to be tough. And the other thing is, kind of these kind of silver or gray divorce, as we're talking about, they're actually kind of getting two new stages of life at once, right? They might be, they're going through divorce, they're going to end up single, and they're not only that, they're entering maybe to this time period closer to retirement. So you're kind of getting a double whammy of life changes at once, which we know can be very upsetting to people. In some cases might be very liberating to others, right? That they actually need and want this change. But sometimes that's going to drive, do they want to keep living in the home? Do they want to relocate? They might not even want to be in that state anymore. Now, some might want to stay there. Some might want to be around. And so what are some things that you want to find out, right? Where is the client's wealth? We heard some of this from Diane before. What type of assets do they have, income sources? Do they want to age in place, right? What is their next goal? Where do you want to live? We want to relocate. Okay, do you want to move every couple years? That's a different conversation than if you have somebody who just wants to move once after the divorce, go to one home and stay there for as long as they possibly can. What is cash flow going to look like in retirement? And obviously that's going to be kind of molded through the divorce process and the agreements, and say how much income are we going to have, and then how comfortable do they feel with a reverse mortgage? Now it's perhaps maybe more important for the kind of in-home divorce individual, right, the one that might want to stay in the home, but it could be just as important as a heck 'em for purchase for the one leaving that is being bought out of the home, that's getting a flow, kind of influx of cash, that really might have really tight income situation after the divorce, and is not going to be able to consistently make mortgage payments. So a heck 'em for purchase could be the best thing for them in that situation. And so here is kind of, some of the ways to start thinking about this. So obviously, as was mentioned briefly before, one of the things for the buyout in the divorce, it actually can help you split up the home value. So you've got a $400,000 home, they're divorcing, there isn't an extra $200,000 of cash sitting around to buy out the other spouse. You could get a new mortgage for $200,000, pay it out, but then again, what does cash flow look like? Well, if not, for kind of people over the age of 62, we can split up usually half the value of the home as a buyout, get that money out to the other spouse, so the one that's staying in the home can consistently live there throughout retirement. Now, obviously, there's other things we need to figure out, but it can help us with that. Now, again, if we have somebody who is staying in the home, maybe even did a buyout, but is tight now on income, well, now all of a sudden a 10-year option, creating a retirement income source for as long as they live in that home, could again be an effective strategy. We saw if we're trying to tie this to Social Security, maybe they need to defer Social Security, they've got a long life expectancy, but they're again limited on other retirement assets. We could use a reverse mortgage as a bridge for that. We could use the line of credit, which obviously is a great feature for a lot of individuals. Set up the line of credit and use it strategically to manage your portfolio. And it's really just a more holistic way of looking at your assets instead of ignoring it. And again, there we've now kind of seen the research say over and over and over again, this is just better than not doing it. So it's actually, in my view, becoming kind of hard to argue that, with at least a line of credit that you shouldn't consider it for a client, because the math and science on that side just says that's a better strategy. The portfolio management without including your home equity is worse. That's what the research and math shows. So it's something we have to deal with moving forward. And then heck 'em for purchase, I kind of mentioned already. Now those really should, I think Dan's going to take over next for us, and I think a lot of those are going to play into some of the things Dan is going to bring up. So I'll send it over to you now, Dan.
Excellent. Thanks, Jamie. So I was asked to give an overview of the reverse mortgage product and then discuss some of the uses of it, the consumer protections, and I'll try to keep it as short as I can. Just keep in mind, A lot of reverse mortgage professionals will spend hours and hours advising on some of these concepts, so we're not going to be able to cover everything in just the few minutes that we have. But let's go ahead and click to the next slide. I'm going to try to answer 8 key questions very quickly. These are some of the more common questions that you'll get, starting with what is a reverse mortgage? Now, when we say reverse mortgage, we're generally referring to the HECM. That is a home equity conversion mortgage. That's the product insured by FHA. Now, there are other reverse mortgage products. It's just the HECM is the dominant product in the industry. We're not talking about the unregulated pre-1989 products that created a lot of the misperceptions that still persist today. So in a few minutes when we see the reforms, you'll also notice the reverse mortgage of today is completely different from those that were offered even a few years ago prior to 2013. But if you want a quick definition of the reverse mortgage, here's a good one. Federally insured loan product that allows homeowners 62 years and older to access a portion or a percentage of their equity now in cash, which is very handy for a divorce, or in monthly payments, or later from a line of credit like Jamie had referenced. So clicking on the next point, what are the primary advantages? Well, everybody likes the notion that there are no required monthly principal and interest mortgage payments required. Well, that's a great advantage, but a lot of people are missing out on the possibly a greater advantage that if you do make payments, the reverse mortgage behaves very much like a forward mortgage, but you have the advantage that your line of credit will grow. So obviously the notion that you don't have to make payments is very advantageous for a divorcee. So in this conversation about silver divorce, that makes sense. If someone's going to stay in the home, they don't have to make any payments, but we can access some of the cash and give it to the departing spouse. All right, so what are the borrower responsibilities? That's the next conversation that we want to have with borrowers and with their financial advisors. No conversation about reverse mortgages is complete without talking about the borrower responsibilities, because this could get them in trouble. The borrower has to occupy and maintain the home. They have to be an occupant. It has to be their primary residence. And they have to pay their property charges, including their property taxes, homeowners insurance. That could mean condo dues, HOA dues, flood insurance. And in many cases, they're not used to doing that. Their forward mortgage did that for them. But we have no required monthly payments, which means there is no escrow, so we have to remove a portion of their principal limit and set that aside. The next conversation we like to have is what is the most common misconceptions? And there are a lot. I'm just going to cover one because it's clearly the most common. No, the bank doesn't get your home. That's generally, if I were to walk down the streets of Atlanta right now and say, hey, why wouldn't you consider a reverse mortgage when you turn 62? Well, I don't want the bank to get my home. That's not how it works. They don't get the home when you close on the loan. They don't get the home when you die. The homeowner gets to retain title and ownership during the life of the loan. It's simply another lien. Next conversation we like to have is what do the proceeds potentially impact? Well, number one, proceeds are not taxed as income, which opens up all kinds of strategies for managing a client's adjusted gross income, the kind of things that Jamie likes to talk about. But you also need to make sure they know that proceeds don't adversely affect their basic Social Security and Medicare. Now, it can enhance those two. It could allow you to delay filing for Social Security. It could allow you to reduce your modified adjusted gross income so you pay less in Medicare surcharges. So it can help Social Security and Medicare. It won't hurt. But you have to be careful here. It could potentially impact supplemental security income or Medicaid, which are means-tested programs. I like to say if we put $100,000 in Mrs. Smith's bank account, she's not going to get her supplemental security. She's not going to get her Medicaid. So we need to be very careful with means-tested government benefits. The next topic is what is the principal limit? Now that's a term we use in our industry. The principal limit is basically a figure that represents how much we can actually offer them at closing, the maximum amount that can be offered at the time of closing. And that amount, or that calculation, is generally tied to the relevant age, interest rate, and home value. Generally, older borrowers get more money because of longevity issues. Interest rates, higher interest rates, you get a little bit less. Right now, we're still in a low interest rate environment, so most of our borrowers are getting the maximum that they can with the reverse mortgage for their relevant age. But then, of course, that percentage is applied to the home's value. Next point is, what is the non-recourse feature? It's a really important topic to discuss because this is a great consumer protection. It states that the homeowner and their estate can never owe more than the value of the home when it's sold. They can never owe more than the value of the home when it's sold. So if property values decline, or if they borrow a lot of money over a long period of time, you might find that the loan balance can exceed the property's value. But when that home is sold, they're not responsible for that deficiency. Neither are their heirs. They're not sticking the heirs with a bill. And then the last of the 8 topics is there's counseling required. And this is a good thing. It allows a third party advise the client. A HUD certified counselor is going to take a look at their situation and advise them on things like the things that I've just covered now. They'll explain other options that might be available to the client. And then when they've completed their counseling, the counselor will give them a certificate that's good for 180 days. And then they need to just make sure that they get an FHA case number assigned within that 180 days. All right, let's shift our focus to talk about who's actually using the reverse mortgages. And this is a nice little graph from my book. It breaks out the 3 major types of reverse mortgage borrowers. And historically, and still today, you think the perception is that the needs-based borrowers are the dominant reverse mortgage applicants, and that's not necessarily true anymore. Historically, it's probably true. That changed in 2013 with some of the regulatory changes, and we now see a lot more lifestyle borrowers or financial planning clients because of the way the loan is structured. But needs-based borrowers are easy to spot. They're house rich, cash poor. They need money now to avoid a crisis. And so in many ways, it was a crisis management tool. But again, that's really a smaller piece of the pie now. We're seeing lifestyle borrowers. They're not desperate or needy, but they might need some money for home repairs in the future. Maybe they need a new roof in a few years. Many of them want to travel. Maybe they want a new car. Sometimes it's just to improve their quality of life. We see cases like a chairlift. I recently saw a case where they renovated the bathroom because of their physical limitations. And so there's a lot of things they can do with the reverse mortgage. If you establish that line of credit early and watch it grow, then you can use it for things like that to improve the quality of life of the homeowner. And then the last category is financial planning clients. And this is where we've really seen a lot of focus lately. I know Jamie speaks very well of these advantages, but the financial planning borrower is looking to use their home equity strategically in many ways, like to reduce their tax liability. If they're drawing, reverse mortgage funds are not taxable. We talked about that. And so if you combine taxable income with non-taxable income, you can reduce your adjusted gross income. That has many advantages with Medicare and capital gains taxes, but some of them are delaying their Social Security. Some of them even use the line of credit in lieu of long-term care insurance. Some people don't even qualify for long-term care insurance. Well, this is a way to fund in-home care, which I know Nirmala had another broadcast on that earlier in the week. All right, let's shift again, and we're going to talk about the new regulations and consumer safeguards with the reverse mortgage. And we'll start in 2013. 2013 was a really big year for us because of all the regulatory changes. And the first one was initial disbursement limits. We found that a lot of people were drawing all the money they could get, especially in a silver divorce, because I did a lot of those. I did some silver divorces, and a typical case was you've got a $200,000 home, and after closing costs, you qualify for cash of $100,000 or more. Well, that would actually be very convenient for a divorce, is to have $200,000 in home equity and be able to, you know, stroke a check to a departing spouse for $100,000. Very convenient. But now that's changed a little bit. in many cases, we can only access up to 60% in the first year, and the other 40% is set aside in a line of credit. Now, that's not always true. If they're paying off a massive loan balance, we can exceed that 60% limitation. But you'll see the next change that happened also in 2013 was the mortgage insurance premiums were restructured. For those that don't need more than 60% of their principal limit in the first year, well, that's an extremely low insurance premium. That's 0.5% generally of their property value as a closing cost. Those that have to exceed 60% are hit with 2.5%, which I would consider somewhat high. But of course, that's a higher risk loan to FHA. So those are the 2013 changes, and some of them really impacted the silver divorce. 2014 also had a change that impacted what we're talking about today, and that's the non-borrowing spouse protection. And historically, if a spouse is not 62 at the time of closing, they can't be a party to the reverse mortgage. This program was designed for borrowers 62 and older. And of course, that posed a problem because the loan becomes due and payable when the last borrower dies. Well, now, non-borrowing spouses that are married at the time of application and reside in the home and continue to reside in the home, well, they may be eligible to stay in the home and defer the due and payable status of the loan. Well, that's great, but there is a caveat that helps us from a silver divorce standpoint. If the non-borrowing spouse does not occupy the home, they are considered an ineligible non-borrowing spouse, which means we don't need to use their date of birth for qualifying purposes. So in some cases, if they're separated, they're already separated, and the departing spouse is already living somewhere else, they are still a spouse. They still need counsel, but we don't have to use their date of birth. And if they're younger, the borrower will get more money. So that's something that we need to keep in mind, especially with silver divorce, because there may be a time when it makes sense for them to go ahead and separate now because they're going to qualify for more under this program with one borrower and not an eligible non-borrowing spouse. Moving on to 2015, and this was a significant change as well. Historically, reverse mortgages were asset-based loan programs, which means really what we're concerned about is the value of the home. But we found that in many cases it wasn't sustainable for the borrower. Well, we don't want that. The lender doesn't want that. The government doesn't want that. And so now we examine credit history, property charge history. We examine residual income to make sure that this is a sustainable solution for every homeowner. And so if it looks like they need additional assistance with the reverse mortgage, shall I say, we're going to set aside a portion of their principal limit to pay property charges to make sure they don't get in trouble with the loan maturing or becoming due and payable because they didn't pay their property taxes. So those are some of the regulations and consumer protections. That's to a real high level. I know went through very fast, but again, this is a conversation you'd normally have over hours and not minutes. So let's send it back to you, Jenny.
Thank you so much, Dan, and thank you to all of our speakers. I think that you've just presented an incredible overview of the different strategies that we could be thinking about when working with divorcing couples who are silver or gray or mature or later on in years. I'd like to turn to some of the questions that our audience has presented to us. If you have questions, please go ahead and post them in the chat section of the GoToWebinar dashboard. So the first question we have is for Diane, and it is, if, say, the husband had the pension and the wife didn't, and if the husband remarries, is the ex-wife still entitled to part of her ex-husband's pension?
That's a really good question, and it really depends on the work that's done in the DRO, the domestic relation order, prior to the divorce agreement being signed. Those issues have to be addressed in detail, because the ex-spouse, there are certain circumstances where they may not be entitled to the benefit once he remarries, but it can, a lot of times, if it's spelled out correctly and using the right options, the ex-spouse can retain and receive part of the benefit in retirement, even if the working spouse has remarried. So this is where that domestic relations order becomes very important, and you must have a knowledgeable DRO attorney draw one up. And then it's really helpful if the financial people on the team, either the CFP or the CDFA, review that DRO very carefully to make sure that that person, the ex-spouse, is covered in case of death, or if the person dies before they are in retirement. There's a whole lot of different options that need to be addressed in that DRO.
Thanks. And as a follow-up to that, I know that we've talked a lot about dividing pensions, but are there rules or strategies for dividing stock options?
Well, yes. So I also, as a CDFA, is qualified to analyze stock options. Typically what I'm seeing right now are restricted stock units and ISOs. So what you do is you would have to analyze there's a potential value, obviously. RSUs, restricted stock units, cannot be divided, but they can be addressed in the separation agreement. They have to be, again, carefully addressed by grant number, and you need to determine what portion of those RSUs or ISOs are marital. And usually it depends upon when they received them and the grant dates into the future. But you just have to analyze them as far as what's considered marital, and then again, that separation agreement has to address them in full detail as how they're going to be handled, who's going to pay the taxes on them, how, when they're going to get liquidated so that the other spouse receives their marital portion of the stock options. And again, that's working with an attorney and a knowledgeable financial professional to get that language correct.
Thank you. And this question is for Dan. If the HECM is set up as a line of credit, does that impact Medicaid eligibility? Is it seen as an asset with regard to Medicaid's asset rules?
It's my understanding that no, it's not, unless those funds are drawn. So you need to be careful about how much you draw. I know in some cases we structured the loan as what's called a 10-year payment or a modified 10-year payment. If the 10-year payment is fairly small, then you can stay under that threshold. But again, you've got to be very careful, and we always advise the client to meet with their federal benefits administrator to make sure that they're not jeopardizing that benefit. As a mortgage professional, I shouldn't really make a definitive statement about that, so they want to meet with their financial planner and also meet with their benefits administrator.
Great. And is that a question that someone could ask a HECM counselor as well?
I don't know exactly how much the HECM counselor would be willing to say on that topic. Again, they may be under the same rules that we are. You really want to make sure you defer to a professional that covers benefits. It's a good question, though.
Here's another follow-up to that. How do you set up tenure payments through the reverse mortgage for the spouse that's leaving?
Boy, that's an interesting question that I'd like to discuss with Diane at some point, because if we can only access 60% of the proceeds up front, there's an additional 40% of the proceeds that are locked up for the next 365 days. And I used to call that the day 1 bucket and the day 366 bucket, because the assumption was on day 366 they were going to draw those funds. Now that's not necessarily true, and we find that many of them won't. They'll see that that bucket is growing. But that's an interesting discussion to have with Diane to find out what future considerations are there for the departing spouse with the line of credit. Because the borrower can change that payment structure at any time. And for $20, they could change from a 10-year to a line of credit or to a term, or even take those funds. So that's maybe something that we'd want to talk to Diane about. Sorry, Diane.
Well, a lot of stuff can be addressed in the separation agreement. And even things that are outside the box like that, as long as there's an agreement and the language is correct, then, and it follows, there's no tax implications that need to be looked at, which from what I'm understanding there are not. And provided the couple is willing to work together, and a lot of this stuff has to happen with couples that are willing and able to talk after the divorce and, have conversations. When you go through litigation, sometimes that's not always possible. Their relationship is forever ruined. But in mediation and collaborative, you can write anything you want in an agreement as long as it's agreed upon and the language is clear. Then really anything can be agreed upon, and it doesn't have to go in front of a judge. The judge reviews the final agreement, but he's saying you have already made it, you agree to this is what you want, then I'm okay with it. So in the case of an equity line and what to do in the future, I'm sure that the language could be worded so that it would be able to be accessed by the outspouse.
That's a great answer, and it just shows that we want a team as reverse mortgage professionals. We want to make sure we team up with someone who can advise on that.
Yeah, and doing it before the agreement is signed. That's the thing. It has to. So the professionals really need to collaborate and work together to make sure that every little issue is addressed and looked at.
This is Jamie. I might jump in. I think Jenny's question also, though, is about a 10-year payment for the spouse that's leaving the home, though. I don't think you would structure or do one of those. I think is actually the simple answer for that one.
No, I wouldn't structure the loan in that way. And, historically the question becomes, well, how much does the departing spouse want? And at least from my experience, how much do they want? And can we meet that? And if we can't with the 60% of the proceeds, then we start looking at the line of credit. But that's great feedback. I wouldn't do it as a 10-year, definitely.
So, Dan, given the new consumer protections and structure around reverse mortgages, what are the main differences between a reverse mortgage and a traditional home equity loan and a home equity line of credit? I know there's a lot to unpack there.
Yeah, well, let me address a little bit of that. A lot of the changes are meant to normalize the reverse mortgage and start to make at least the underwriting guidelines somewhat similar. But when you're comparing to a HELOC, which is your typical home equity line of credit that you can get through your bank or credit union, those are so totally separate because the reverse mortgage HECM line of credit is guaranteed. It works great as a long-term financial planning tool. The HELOC is a great short-term quick fix for a project that you want to make payments on and pay that off. It's not secure. It's not guaranteed. And many of us remember back in 2008 when our HELOCs got yanked out from under us very quickly. Well, that doesn't happen on the reverse mortgage side. So as a financial planning tool, the reverse mortgage is structured for long-term financial planning. Does that kind of answer the question?
Yes. And could you also explain again the non-borrowing spouse protections a little bit? Yes, okay.
Yeah, what we found is a few federal statutes indicated that the spouse of a borrower on a federally insured loan can be considered a homeowner, in quotes. Well, the reverse mortgage was never structured for non-borrowing spouses, and so we found that a lot of the bad press that we got and some of the legal issues that happened at one point were surrounding someone who was not on title, not on the reverse mortgage, but left in the house after the borrower died. And obviously we don't want that to happen. We want to make sure that non-borrowing spouses are protected, but we need to gauge that risk of having someone, say, age 55, being able to stay in the home for the rest of their life. And so now with the non-borrowing spouse regulations, let's say a 65-year-old is married to a 55-year-old, the 65-year-old will qualify for less money because we have to gauge the risk of having a 55-year-old live in the house for the rest of their life. And so you'll find the principal limit factors go down. And we have seen cases where you have a big disparity between one borrower's age and the other borrower's age. We're going to use the lesser of the two, or the younger of the two. It will be the younger, the age of the youngest borrower or non-borrowing spouse, eligible non-borrowing spouse. And remember, eligible non-borrowing spouse means they're married and that they occupy the property. An ineligible non-borrowing spouse means they don't occupy the property right now, and so they don't qualify for the deferral, so we don't have to use their age in the calculation. Just remember, older borrowers generally qualify for more money. If they're married to a younger spouse that's not on the reverse mortgage, they're going to qualify for less.
So is there a minimum age for the non-borrowing spouse to be able to get that protection?
Yes, but we don't talk about that. It's age 18. So it does go down to age 18, and I think they qualify for about 30% of the property's value in that case. And so there are principal limit factors all the way down to that. The farthest I've seen is actually a 74-year-old married to a 47-year-old. And that's the largest age disparity that I've had as a potential client.
But that person can still stay in the home for...
Yep. Now, there are restrictions. Of course, that is upon the death of the last borrower. So if the borrower dies, that non-borrowing spouse has the ability to stay in the home, but they need to make sure that they probate the will or make sure that they take ownership of the home. So that needs to take place first. They need to make sure that they pay their property taxes and insurance because the loan could mature for other reasons other than the death of the spouse. So the non-borrowing spouse is protected if the borrower dies. Now, there are other maturity events that could take place and the non-borrowing spouse wouldn't be protected, and we need to make sure that we move towards regulatory reform that protect those spouses as well.
Agreed, agreed. Diane, in California, Proposition 60 allows an older homeowner to sell their home and purchase a replacement home of equal or lesser value and maintain their property tax base. Do you know if this provision can be used by both departing, divorcing persons? Are you familiar with that?
No, unfortunately, I'm in Massachusetts, and Massachusetts and California, while being not only on opposite ends of the states, but they are completely different when it comes to divorce. So unfortunately, I cannot answer that question.
Thank you. Well, I'm looking through these questions, and I see another one on non-borrowing spouse, but this one, Dan, is very specific to Texas. Do you know if there's any progress happening in Texas on non-borrowing spouses?
Boy, I sure hope there is, and I know state law conflicts with what we want to do with the reverse mortgage there. I'm not up to speed right now on state law, but that's a very good question, and I know Texas eventually comes around and makes some regulatory changes on a state level that have slowly started to help us out, but I hope we're working in that direction.
Terrific. Well, we're coming up to the end of our hour, so I just want to thank all of our speakers again, Diane, Jamie, Dan. You guys have been incredibly helpful. For our webinar attendees, please visit reversemortgage.org to learn more about how reverse mortgages work and the protections available to borrowers, and also to read real-life stories of people who have used reverse mortgages for different purposes. Thank you all again, and feel free to contact the National Reverse Mortgage Lenders Association with any additional questions. Thanks.